Dividends and share repurchases. In this reading, we cover the basics. A more advanced version of this material is presented at level 2. We will talk about the different forms of dividends, dividend payment chronology, share repurchases, and then in the curriculum there is a segment called concluding remarks, which I will not cover because this material is not mentioned in the learning objectives. It's an interesting section though, and if you have time, it might make sense to read it. As we have discussed earlier in the reading on cost of capital, a company raises money through owners or through lenders. In this particular slide, since we are talking about dividends and share repurchases, we are only considering owners or equity holders. Equity holders contribute money to the company, and notice that the company and the owners are distinct legal entities. The owners contribute money or give money to the company because they expect a return. The return is in the form of cash dividends or share repurchases. This reading focuses on the different kinds of dividends. Let us discuss the different types of dividends at a high level. Broadly speaking, dividends can be divided into two categories. Dividends where the shareholders actually get money, and dividends where the shareholders simply get more shares but no money. In the money category, we have three types of dividends: a regular cash dividend, extra or special dividends, and liquidating dividends. In the non-money category, we have stock dividends and stock splits. Let's first talk about the category where the shareholders get cash. And in that category, the major one is regular cash dividends. Here, cash is distributed to shareholders on a regular schedule. When we talk about regular over here, we are talking about a schedule. A company might pay a dividend every quarter or twice a year or annually. Most dividend-paying companies strive to maintain or increase their dividends. Increasing dividends indicates that a company is growing and is willing to share profits, and generally this is taken as a positive signal. Some companies offer dividend reinvestment plans. These are also called DRIPs. What happens here is the investor is given the option of buying more shares with the dividends. So, for example, if an investor has 100 shares and he gets a $10 dividend on each share, the investor can say to the company that rather than giving me a $1,000 dividend, you simply use this dividend to buy more shares for me. And more shares will then be bought based on the market price of the shares. A company needs to have a dividend policy or a dividend payout policy. This indicates how much dividend a company will pay, when it will pay the dividend, and so on. This material is covered in more detail at level 2. At level 1, you simply need to understand the concept of the payout ratio. A company generates income, net income, and dividends are paid out from net income. As we have discussed several times in this course, the net income can either be retained or it can be paid out as a dividend. The percentage of net income that is paid out as dividend is called the payout ratio. If a company has net income of 100 and the dividend is 40, 60 is retained, then the payout ratio is 0.4 or 40%. I would encourage you to read example 1, which illustrates this concept. Extra or special dividends, these are also called irregular dividends. This is a dividend paid by a company which does not normally pay dividends, or payments to shareholders which supplement regular cash dividends. Let us look at a simple example. In the 90s, Microsoft did not pay any dividends, but it had built a huge amount of cash and wanted to give some of that cash to shareholders. So Microsoft announced a special dividend where it gave a certain amount of money to every shareholder. That was categorized or announced as a special dividend because Microsoft did not want to set expectations that it would keep giving this dividend. You can simplistically think of these as a one-off based on circumstances. A company might be paying a regular dividend, but on a one-off basis might want to make an extra payment to shareholders, perhaps because profits in a given period were much higher than expected and the company does not plan to reinvest that money. Again, if the company does not want to categorize or does not want to set expectations that it will keep giving a higher dividend, then it can indicate that this is an extra or a special dividend. Liquidating dividends. If a company goes out of business, it will sell its assets, settle liabilities, and then what is left will be distributed to shareholders. That distribution is called a liquidating dividend. This concept also applies if a company sells a business unit. There again, if the money is distributed to shareholders, it would be called a liquidating dividend. If a dividend is paid which exceeds accumulated retained earnings, then this also is categorized as a liquidating dividend. For example, if a company has retained earnings equal to 150 and contributed capital equal to 200, and if a company makes dividend payments equal to 250, then the entire 150 is being used up and the amount of contributed capital will also come down by 100, so it will come down to 100. This would also be categorized as a liquidating dividend. Stock dividends and splits. These are non-cash dividends where shareholders simply get more shares. With a stock dividend, the company distributes additional shares, typically between 2 and 10% of shares outstanding. Shareholders simply get more shares, but each is worth less. The overall market capitalization does not change. Stock splits are similar. You can have a 2-for-1 split or a 3-for-1 split. In fact, there are several different kinds of splits. A stock split is economically similar to a stock dividend. If you take a 2-for-1 split, that means that a shareholder who has one share worth 20 will have 2 shares worth $10 each after the split. If you think about it, economically, a stock split, a 2-for-1 split, is very similar to a 100% stock dividend. The accounting treatment is a little different, but you as a CFA candidate do not need to worry about the accounting treatment. As I mentioned, you can have other types of splits. You can also have reverse splits where, let's say, 2 shares are combined into 1 share, and this particular scenario is discussed in example 2 in the curriculum. Stock splits help companies keep the share price in a certain range. For example, if a company wants to keep its share price in the $20 to $80 range and the company is doing really well, such as take a company like Microsoft in the 1990s, then to retain the share price in this range, the stock needs to keep splitting. If Microsoft had not ever split, then the stock price would be extremely high today and most people would not want to buy a stock that is trading in the thousands. What I have discussed here implies that the economic reality does not change when a stock is split, and that in principle is true. However, academic research suggests that market values tend to increase because dividends and splits are taken as a positive signal. So note that when a stock splits or if a stock dividend is announced, that transaction in of itself does not change the market value, but the stock dividend or stock split is often taken as a positive signal because investors think that a company that has announced a split would only be announcing a split because it expects to do well. Investors take that as a positive signal and might bid up the price a little bit. However, if the company does not perform as per expectations after that, then the stock price will come back down. Let us look at the effect of a stock dividend now. A company has 1 million shares outstanding, and let's say you own 500 shares. What is the impact of a 10% stock dividend? As we've discussed, with a 10% stock dividend, the number of shares outstanding increases by 10%. If the EPS before the dividend was 1, then we can see that the total earnings must have been 1 million. After the dividend, the earnings are still 1 million. So what is the EPS? The EPS would be the earnings 1 million divided by the total number of shares outstanding. So the EPS comes down to 0.91. The total market value of the company, however, stays the same, because economically the company is still making the same amount of earnings. The total market value was 10 million before, it is still going to be 10 million. The stock price is going to come down. Originally the stock price was 10. It will come down to 9.09, and notice that if you multiply the shares outstanding with the stock price, you should still get 10 million. The PE ratio will not change because the price per share comes down and the earnings per share is also down by the same proportion. Now coming to your situation, you had 500 shares. After a 10% dividend, you have 10% more, or 550. But if you multiply 550 by 9.09, notice that your value is still 5,000. So you still have the same proportionate ownership of the company. Your proportionate ownership was 5,000 divided by 10 million, and after the dividend, your proportionate ownership of the company is still 5,000 divided by 10 million. What I have illustrated here is the impact of a stock dividend. The impact of a stock split would be exactly the same. The numbers would be a little different. If you have a 2-for-1 split, then shares outstanding would go from 1 million to 2 million, but the overall calculations are the same. If you want to see this in detail, there is an illustration in the curriculum. Coming now to the impact of dividends on capital structure and ratios. When a company pays cash dividends, obviously cash comes down, which means that assets come down. Assets are equal to liabilities plus equity. If assets are down and liabilities are unchanged, then obviously equity comes down. If equity is down but debt or liabilities are unchanged, this means that the capital structure of a company changes. What is the impact on the current ratio and the debt to equity ratio? Current ratio is current assets over current liabilities. Current liabilities do not change. Current assets are down. That means that a current ratio will come down. Debt to equity ratio, debt stays the same. Equity comes down, which means the debt to equity ratio goes up, which is a negative. So paying out dividends actually hurts ratios. With stock splits and stock dividends, the capital structure does not change. We simply divide the pie into smaller pieces. The pie is the total amount of equity. You can think of each slice of the pie as one share. If we have a 2-for-1 split, then all that means is that you take a given slice and divide each slice into 2 pieces. So notice that now we have smaller pieces, but the total equity or the total pie does not change. Hence, there is no impact on the current ratio and there is no impact on the debt to equity ratio. We'll now talk about payment chronology. Declaration date is the date when a company announces that it will pay a dividend. The company announces how much dividend it will pay, when the payment will be made, and the company also announces the ex-dividend date. The ex-dividend date is the first date that the stock will trade without the dividend. Let's say that the company declares the dividend on 10th January and the company says that the ex-dividend date is 15th Feb. If on average the share is trading for $30, or let's say just before 15th Feb, the share is trading for $30, and the company has announced a $2 dividend, then approximately the share will trade for $28 on the ex-dividend date. That's because somebody who buys the share on 15th Feb, which is the ex-dividend date, will not get this $2 dividend. On the other hand, somebody who buys the share on 14th Feb will be getting the $2 dividend. Hence, it makes sense that on the ex-dividend date, the share price falls by roughly the amount of the dividend. I say roughly mostly because of present value effects, but given the short time frames involved, the impact of present value calculation would be very small. Typically, 2 days after the ex-dividend date, we have the holder of record date. This is the date where the shareholder listed in a company records will be deemed to have ownership of the shares for purposes of receiving upcoming dividends. The company sends out dividend checks, and obviously the company needs to know who it is sending those checks to. In other words, the company needs to know the list of shareholders, and you can think of this date as the date by which that list is updated. In our simplistic example, let's say that the holder of record date is 17th Feb, which is 2 days after 15th Feb. And then the payment date might be 10th March. Obviously, that will be a little bit of time after the holder of record date. This is where the dividend is sent out to the shareholders. I now want you to do examples 3 and 4 from the curriculum.